Good afternoon and welcome to today's webinar on bank business models and systemic risk, rethinking regulation in an era of polycrisis. So this webinar is organized by the Euro-Mediterranean Economists Association in cooperation with the Vice Business School, City University of London, and also under a collaborative research project on which we've been all collaborating now for the past years on bank business models, and all the research we're doing is freely accessible. So thank you very much for joining us today at a time when the global financial landscape is again under growing strain. Obviously, we see, in the IMF spring meetings, clearly this month, in the IMF report, latest the Global Financial Stability report that they have already published in April 2025, clearly systemic risks have intensified amid tighter financial conditions. And we clearly see that there are elevated asset valuations and also deepening of the geopolitical and trade uncertainty. And all the markets are really quite in high volatility, and we can see it all over the places. Now, non-banks financial institutions seem to have high leverage, and this was also mentioned by the IMF report. And there is a growing linkages between traditional banking sector and also all these new financial institutions that are also taking a lot of role in the financial systems. And these are all adding growing sources of fragility. The second point, which was mentioned by the IMF report, is the sovereign debt vulnerabilities. We can clearly see that emerging markets are adding further pressure to financial stabilities, particularly, for example, if we look at the African markets and the debt crisis over there, I think we see that there are pockets of financial vulnerabilities that are growing pretty fast. Adding to this is the fragmentation between Europe, the US, and the beginning of the end of the transatlantic agreement, and the growing role of China in terms of finance, while little, in fact, to no transparency is warranted. So it's really, we are living in reality in a complete different environment. And this reminds me of the financial crisis of 2007, 2008, where we started really seeing this accumulation of risks and in a way, the difficulty of preparing for the worst to come. So all these developments that we are seeing nowadays point to a fundamental truth, that we think that traditional regulatory approaches focusing on primarily capital adequacy and liquidity, eventually all these counter-cyclical measures may not be enough in the environment and the geopolitical and macroeconomic environment we are living in today. So business models comes again, of course, financial institutions at the forefront, because we need to understand a little bit further the business models of financial institutions, whatever is called financial institutions, also shaped by the digital innovation and artificial intelligence, the new sustainability mandates, if they are still, in the forefront by the leaders, and also understanding better the market structures. And I think then we can also either mitigate or amplify those risks, because at the end, the interaction between all these elements, which are quite new also in our financial systems, might amplify or might mitigate the global systemic risk, depending how they are dealt with. And also one question I'm asking myself, what are the consequences if there are no global regulatory coordinations between the authorities? And we see clearly that there is divergence nowadays. So What is, for example, the role of the global coordination, like, for example, the Basel Committee, in an era where eventually there is much more fragmentation? So how can we deal with it? So today's webinar brings together distinguished panel of experts from academia, financial regulatory authorities, public policy, industry, and also from a consumer protection standpoint to address these questions and try to understand where we're heading. So as I mentioned to you already in our note that we have mentioned, or we have sent to you, we would like to explore how the bank business models influence risk profiles, how supervision and regulation may evolve to reflect these differences. What are the institutional tools we have? What are the regulatory tools we have? What are the data that we need to improve really this, data infrastructures and also eventual cross-border cooperation, and how we can build ultimately a more resilient global financial system. So, of course, we have done a lot of research. As I mentioned at the beginning, we have shared our work on Bank Business Model Monitor, which we published last year, but also a paper that we have just published on bank business models and systemic risk. So this is also giving us some evidence where we're heading, and then will also help us to refine our research agenda to understand a little bit, the new, I would say, the developments that we are all facing. So we hope that today's dialogue and conversations with you will try to give us a collective understanding about what is happening on the ground, but also try to think forward and give us more insights on our research agenda and research priorities to allow us to put our efforts together to continue this research and really inform, for example, the build-up of a more adaptive macroprudential framework, and also eventually even start thinking about innovative frameworks that would answer to the challenges we are facing today. So before we begin, I just want to have a quick note that this webinar is recorded publicly now. It's recorded on live. And if you have questions, you are encouraged to share them on the Zoom Q&A function. And then please keep your cameras on during the discussion. So this is an interactive discussion. And I'm very, very happy to see you all with us today. So I would like to start with the first speaker, and this is my colleague, Doriana Cucinelli. She is Associate Professor of Banking at the University of Parma in Italy, and she is a MEA Research Fellow. And she will give us an overview on the origins of financial instability based on the research we have been doing together over the past years. So please, Doriana, the floor is yours.
Yes, thank you. I'm really sorry, but I can't open my webcam because I have some problem. So I share, but I can share my slides. Okay. So yes, this my first intervention is to give some more details on our paper that is published on Journal of Financial Stability. The paper is on the origin of financial instability and systemic risk. Do bank business model matter? And this paper is co-authored with Rima Iadi, Paola Bongini, Barbara Caso. The first things that I want to say is that we try to understand better what bank diversity means. We can talk about several types of diversity in terms of bank size, systemic nature, complexity, and also in terms of bank business models. When we talk about business models and we look at the literature review, there are a lot of definition of business models, but till now there is not a common definition. And in our work that starts in 2010, when we start to talk about the bank business model, we start with a first definition that considers the institutional diversity, and we distinguish between those banks that are more stakeholder-oriented from those banks that are more shareholder-oriented. We also start to detect the definition of bank business models, and in this case we focus on the differences between asset and funding, asset and liabilities in the balance sheet. So to define the bank business models, we adopt an activity funding approach. This means that we consider more the structure of the balance sheet in terms of the activity and the funding, because we want to try to answer to the question what the bank do and how bank make their performance, they obtain, they achieve their performance. We start in 2010 on a smaller sample of European banks, and during the last more than 15 years, we enlarge this sample, and we also try to observe the bank business model of other countries, such as the US, Canada, and also MENA and Africa countries. How we arrive to our bank business model definition, we use a cluster analysis, and in particular we use a VARD approach that allow us to use few balance sheet indicators, and in particular we select 5 different balance sheet indicators. We arrive to these indicators after a long study of the different indicators that we can use from the balance sheet of banks, and we obtain our business models. What are business models in our research? We obtain 5 different business models: the focused retail, diversified retail type 1 and type 2, wholesale, and investment business model. We have on one end the focused retail banks that are those more traditional, and as you can see from this picture, the focused retail banks are those with the higher level of customer deposits on the liability sides and customer loans on the asset side, so a more traditional activity. With regard to the investment banks, the light blue line, you can see that obviously are those banks more market-oriented with a higher level of trading asset and debt liabilities. We have also wholesale banks that are those banks more oriented to the other financial institution with high level of bank loans, and in the middle we can find the diversified retail banks. We distinguish them between type 1 and type 2 because it depends on the composition of asset and liability sides. With regard to the type 1 banks, so the orange line, you can see that in terms of liability sides, they are very similar to the focused retail banks, while they differ more in terms of liabilities. In fact, they have lower customer loans, but on the asset side, they have lower customer loans and higher trading assets. On the contrary, diversified retail type 2, so the gray line, are more similar to focused retail banks on the asset side with similar level of customer loans, but they differ on the liability side, where they have not only customer deposits, but also debt liabilities. So this cluster analysis allows us to identify 5 different bank business models. We use this definition for the subsample of listed banks that are 217 listed banks during the period of 2005-2020 to study the relationship between bank systemic risk and bank business models. But why regulators and supervisors should analyze bank business models? The reasons are several, but obviously the main reason is that a better understanding on which are the bank business models adopted by European banks could be important, could be crucial to also try to obtain a more sustainable banking system. In fact, as you know, the business model assessment is today requested also by the SREP, and banks have to focus both on the business model viability, so on the short term, so on a short horizon of 12 months, and also the business model sustainability with a more forward-looking approach, more oriented to a longer time horizon. So what we do in our paper, we try to understand the relationship between bank business model and systemic risk, because during the last 20 years, the European banking system have navigated numerous challenges. And in particular, we have faced several types of crises: the financial crisis, the European sovereign debt crisis, that are two examples of endogenous crises to the banking system, but also other kinds of crises, such as the geopolitical events, the Brexit, the COVID-19 pandemic, and also recently the Ukraine war and the trade wars started by Trump at the beginning of this year. These are examples of exogenous crises to the banking system that derive from the economic system. During this period, the systemic risk is increased a lot, and we want to understand if, depending on the bank business model adopted by banks, the level of systemic risk can be different. From these first pictures, we can observe that depending on the measure of systemic risk that we consider, the differences among bank business model can be different. We adopt on one end the delta covar as a measure of contribution to systemic risk, and the mass as measure of exposure to systemic risk. In both cases, we observe that during period of crisis, the systemic risk increase, but we can observe that there are greater differences in terms of mass when we consider the different bank business models. So what we find in our paper? We find that in general, during period of instability, investment banks and diversified business models show the highest level of both mass and delta covar. However, it's interesting to note that during tranquil periods, so when there are not crises, focused retail and wholesale banks exhibit higher exposure to systemic risk than investment banks. So also considering the tranquil periods could be interesting to observe how different banks can contribute and can be exposed to systemic risk. When we distinguish between exogenous and endogenous crises, we can see that also in this case, depending on the bank business models, the exposure and contribution can be different. In general, investment banks are those that have higher contribution and also higher exposure in both type of crises. But if you look at, for example, diversified retail banks and wholesale banks, the results can be different depending on the type of the crisis and the type of the measure of systemic risk that we consider. So to conclude, we believe that considering the bank business model is relevant because allow us to better understand how banks are exposed and contribute to systemic risk. Regulators aim to limit obviously systemic risk, and usually they introduce macroprudential rules to improve bank stability. However, in our opinion, it's important that these rules are not one size fits all, because as you know, we have a very heterogeneous banking system, and this means that depending on the characteristics of banks, the macroprudential policies can have different effects. Moreover, we think that it's really important to have this diversity in the European banking system because, as Butzbach underlined, diversity is valuable as guarantee of stable banking system. So the macroprudential rules should be more design on the different types of banks, and also they should try to improve the diversity in the banking system. Thank you.
Thank you very much, Doriana, for sharing the results of this research. Of course, this is one element of the research that we're doing. We're trying to continue monitoring the bank business models within the European Union. And as mentioned by Doriana, we are now trying to get more data on other countries and other regions of the world to better understand bank business models and systemic risk per country and per region. So I would like to launch directly the discussion with first Barbara Casso, Professor Casso. She's Professor of Banking Finance and the Director of the Center of Banking Research at the Vice Business Schools, City St. George, University of London. And also she's a member of the advisory board of the Euro-Mediterranean Economists Association and a co-author of this research. And also we've been working together on these elements for many years now. Barbara, what is your view on the future of research in this on this topic, aligned with the all these global uncertainties that we are living in, and also align with, for example, this fragmentation that we're seeing, between, for example, particularly between Europe and the United States. Please, Barbara.
Thank you, Rim. Thanks for inviting me to contribute to this seminar. Of course, I am biased on the importance of bank business models because we've been working on this theme for a very long time with you and with Doriana and with others. What I think is that in recent years, we have seen a growing understanding of the importance of the compositions of banks' balance sheet. And there is a growing recognition from policymakers and regulators that a deep understanding of how banks work and how this evolves over time is very important to understand the safety and soundness of banks. This has come to the fore during the mini financial crisis, as you want to call it, of 2023 in US banks with the failure of Silicon Valley Bank and other banks. And this episode really showed us the flaws of the business models of these particular banks and the risks that these banks were exposed to, both on the asset side, so the lack of diversity in the asset side composition, and particularly the risks that they were taking on the liability side. And looking at these cases with hindsight, and this is a wonderful thing because hindsight is always a wonderful thing, but you can see how the business models of these banks had changed and had changed really rapidly. And it was out of line both with what they were doing even 5 years prior, and also what they were doing compared to their peers, which has led to an accumulation of risk. So understanding these dynamics of how banks change their business models to react to macroeconomic circumstances, to react to interest rate hikes or interest rate decreases, inflation and various other circumstances, is also important to have a more dynamic approach to understanding the risks that these changes in business models can bring to the point that they might bring to the failure of particular financial institutions.
Thank you, Barbara. So how do you see particularly the new digital innovations and artificial intelligence impacting the bank business models in such a way that to enhance homogenization of the system, or eventually complete diversity of the system? So how do you see the impact of these trends, and whether you think we could better understand the business models with this type of innovations?
This is a very big question. So the impact of technology has definitely changed the way the banks do businesses and relate to customers, and they have moved into new areas. So there are different asset classes, there are different types of doing business. But for what concerns our research on business models and how this can impact regulation, the way that I see this having an impact is twofold. The first impact is on the speed of the transmission of risk. And in fact, there is quite a lot of research that shows that Silicon Valley Bank was potentially the first digital run, when news on the bank and the run on the bank didn't happen in a traditional way, but it happened online very quickly. And this really puts a lot of emphasis on regulators to intervene even quicker and read these signals even quicker. In terms of the understanding of banks' business models, and this is where I know some regulators are already using AI tools for example, the estimation of early warning systems, is that it gives you the opportunity to look at these changes in banks' trajectories and balance sheet and compare it a lot quicker than individual analysts would have been able to do. So the development of various technologies to pick up risks and pick up the evolution of risk and raise particular aspects of banks' activities, this certainly will improve analyst jobs and regulators' job. But fundamentally, you still need to be able to read these outputs, and you need to understand how banks works. So the understanding of the business models that banks are using is still very relevant.
Thank you very much, Barbara. So I would like to move to Judith Arnal. Judith, she is an Associate Senior Research Fellow at the Center for European Policy Studies. And also she's the board member of the Bank of Spain, and she has written a lot on financial stability, financial systems. Judith, how do you see the policy frameworks, I would say, evolving with the, of course, the research that we have shown, but also in terms of the global uncertainties that we see nowadays? What is your view about the future of financial stability at EU level and also financial architecture?
Thank you so much, and many thanks for the invite to this seminar. I'm really enjoying it. I'm learning a lot from your research, so thank you so much. So, I mean, to start with a positive note, if we look at all the progress that we've made in the EU in the banking sector, it's pretty incredible. So 15 years ago, the banking sector was a problem in terms of financial stability. And I'm thinking about my own country. We need to request a financial assistance program for the European Stability Mechanism to inject capital on some of our banks. 15 years later, we see how the EU banking sector is much more resilient. And I think that a proof of that is what happened during COVID-19 crisis. So it's not that the banking sector was not a problem, it's that it cooperated towards finding a solution. I'm thinking, for instance, about loan moratoria or about the channeling of loans with public guarantees. And Barbara was mentioning the case of EU's US regional banks I think that it's a very nice, very recent case of why business models matter in banks. And we see how the EU withstood all that pressure. So we can come to the conclusion that the past structural reforms introduced in the EU, mostly the single supervisory mechanism, have played a positive role. But what do financial markets tell us? I think that financial markets tell us a different story. So if we compare, for instance, the market capitalization of JP Morgan with that of the 10 largest EU banks, in 2015, the capitalization of JP Morgan was 210 billion euros, vis-a-vis 530 billion euros of the 10 EU largest banks. In 2024, so 10 years later, the capitalization of JP Morgan was 680 billion euros, whereas that of EU, the 10 largest EU banks, had decreased to 512 billion euros. So clearly, there is something that financial markets are pricing in, and that is not exclusively related to having a sound framework. So here, to me, come the structural problems of the EU banking sector. Before the hike in interest rates, we saw that the cost of equity, the average cost of equity of EU banks, was above the return on equity. Now, thanks to the increase in interest rates, it's the other way around. And again, a clear example of why business models matter. Profitability has increased more in Spanish and Italian banks than in French and German ones, basically because on the asset side, we had more variable rate loans, whereas French and German banks had more fixed rate loans. So in terms of net interest margin, they could not profit that much. But still, it looks like there's something structurally that is not working. Of course, we don't have a banking union. There are a lot of political pressures against a merger between two big EU banks. We don't have a capital markets union. But still, even from a regulatory point of view, there are some things that are striking. When we think about the funds that the industry needs to put in the EU into national deposit funds and the single resolution fund, it's way above those in the US. But then one goes into the nitty-gritty of the regulation, and it's very difficult to have access to the funds in the single resolution fund. So basically, we're building huge safety nets, which at the end of the day, we cannot really use. Then thinking about before you mentioned, Doriana mentioned that one size fits all doesn't work, which I very much agree with. But if we think about the EU, we see that Basel standards are applied to every single bank, whereas in principle, the requirement is to apply this to internationally active banks. You were asking, Rim, about what will happen from a global perspective. To me, it's pretty clear that the US will not implement Basel III Endgame. That's super clear. We have taken some mild steps in the EU, postponing the entry into force of the fundamental review of the trading book. But of course, now the question is, what do we do? In the short term, of course, doing this will increase the competitiveness of the EU-US banking sector. Ceteris paribus, I mean, if they start doing some other crazy things, I think that there could be even a collapse. But ceteris paribus, this can increase the competitiveness of the US banking sector. But in the midterm, of course, financial stability risks really increase. And as we saw during the US regional banking crisis, it's not only a business model issue. So it's not only the managerial part of the bank, it's also why supervisors allowed that kind of business model to go forward without thinking about what financial stability implications that could have, and why did regulation not cover it? So I think it's really important, and it's, as Doriana was mentioning, the business model part is already one of the 4 core pillars of the supervisory review and evaluation process. There's this wise persons group report that provides some nice input as to how this should evolve. So I do really think that we need to be prepared not to see financial stability, instability episodes coming from the EU, but coming from abroad, coming from the US, and how that could have an impact on us. So really thinking about how to adapt regulation accordingly makes sense. This principle of one size fits all doesn't make any sense, but not only from a macroprudential point of view, I would even say from a microprudential point of view. And also, I think that we should not only think about financial risks. Going forward, we should also focus very much about the impact of digital and climate risks, because now that banks are going more and more digital, they could disappear from one day to the other simply due to a materialization of operational risk. So basically, this requires, I think, then broadening a bit the scope of the risks we're thinking of and the measures that we put on the table. Before you were talking about the impact of technology on financial stability, I think that there could also be an increase in biases, because at the end of the day, if all banks use the same AI technology provided by the same major companies, there's a risk that there could be the same biases. So I think that that's worth looking into, and I'll leave it at here for this moment. Thank you.
Thank you, Judith, for giving us this overview, which really only consolidates the view that we are trying to face a complete new truth of our markets. And we might not have enough tools nor the appropriate frameworks to assess these risks that we don't even know whether we can still use I would say the past risk matrix, like you mentioned, operational risk, credit risk, maybe market risk, reputational risk. And nowadays we have completely new risks that are emerging, but they are going pretty fast. And that's also the point that Barbara mentioned, the speed. I mean, things are moving pretty fast, much, much faster than our capability to monitor these risks, and at least based on our human, I would say, capabilities, unless we use artificial intelligence capabilities to be able to do it. But then who does it quicker than the other one, and where the accumulations of risks would be seen and when they would be seen? That's my question. Okay, now perhaps I have one element which I don't even know if it's provocative or not. Is really Basel III still the right framework to manage the accumulation of risks and financial stability in our systems? So this question to you, and then I move on.
Okay, I mean, it's a very tough question. I mean, it looked like it was, right, when it was agreed. So I think that we need to really disentangle why and try to really identify why we are doing things. So are we thinking that Basel III is possibly not the right framework because the US does not want to implement it, and then we need to move the goalpost simply to try to keep a global framework? Or is it because we really think that there are new risks appearing on the table and that it's not comprehensive enough? If it's the second reason, then to me it makes sense to revisit it. But if we are only going to reopen things because geopolitically speaking, a very major jurisdiction is not in a position to implement Basel III, then it's not the right answer. Personally, I think, and I do agree with you, that we need to move beyond capital requirements, liquidity requirements in a moment where digital and climate risks are increasing. But then we need to build the right framework and not. I think that it's all in terms of rhetoric to the outside world. It's also very important that if a proposal is made to change Basel III, it's for the right reason. It's because there are new risks, because it's not comprehensive enough. It's not because of the US not wanting to implement it.
That's very clear. Thank you, Judith. I would like to introduce Pervenche Berez. She's the president of the Association Europe Finance Régulation. Pervenche was the member of the European Parliament between 1994 and 2019. So she lived financially all the crises over there. And I had the opportunity to collaborate with her when I was in Brussels, when she was chairing the Committee of Economic and Monetary Affairs between 2004 and 2009. And obviously, she was a rapporteur of special committees on financial, economic, and social crisis, 2010, 2011. So Pervenche, you had an ample experience, and you saw, actually, you lived the crisis of 2007, 2009, and all the crises afterward. I mean, of course, this crisis that we're living, not yet a crisis, it's deep uncertainties that most probably will end up in a crisis, and we don't know where it's coming from. Or maybe it's a polycrisis that we will have to face at the same time. With tools eventually and frameworks that may or may not function, or with much less environment for this global coordination that we experienced before the new American administration. So now facing a crisis collaboratively, or a polycrisis collaboratively within a fragmented global governance, it will be a matter of a big challenge. So what do you think about all of this, Pervenche? And how do you see our thinking of these dynamic bank business models and trying to adapt by going is an approach, or maybe an approach among other approaches? Please, Pervenche, the floor is yours.
Him, it's a real pleasure to have this discussion with you. It sounds like it was to me like it was just yesterday, but yesterday we were discussing Basel II, so that's another world, huh? And thank you for your introduction and the question the angle you suggested to me, because this is exactly where I want to go. So my question is, we are in a world of uncertainty. There might be crisis coming, but by definition, we never know the risk that is going to explode. So whether it's from the market, from the operational side, you don't know, but you try to get ready for that. And I think the last example of a crisis, even though it might not be of the magnitude of the next one, but is what has happened with SVB and the Credit Suisse. And I think for EU, this has been a crash test that we need to look back at. There is the business model of the two banks concerned, SVB on one side and Credit Suisse on the other side, in question. And obviously, entering this discussion like this, the answer is going to be no. Because SVB, the business model of SVBs and the business model of Credit Suisse has nothing to do. And you could also say that SVB was a very simple model. So I believe in your definition, it would nearly belong to the first category of banks. Nevertheless, it ended up in a systemic risk. And I think since the great financial crisis, we've seen that. We've seen that whatever the business risk is, you can get into trouble. Maybe mainly for the reason you mentioned, which is the reputation risk. And of course, this is a discussion we used to have mainly when we discussed MMF, but now it's not only about MMF, it's also about banks. And this is what we have learned with SVBs. So for me, and you will not be surprised by this, the entering point is same risk, same rules. And rightly so, I think in this part of the discussion, the Commission is on this line, and I think, or more or less on this line, and I think, but for me, this is the right attitude. Also because I think it's Judith who just referred to the risk related to IA, and what we have learned from SVBs is that IA is just changing the rhythm and the magnitude of a risk, whatever the business model is. So that's my first very important point. Second point, if you're going to discuss the business model, and I must admit I didn't read all the words of your two papers, because they are very tough papers, but I've been doing my study and my duty and reading through them. But somehow you're re-entering this debate about somehow some kind of proportionality, even though the word is not in the title. And for me, then the debate is the proportionality versus the prudential solidity. And this, because we know the price of the interconnection, I think we cannot give up this issue of the prudential approach, whatever we think about the next crisis. And I think if we look at the past example in the EU, even before we enter this 2023 crisis, you had different size of, you also, I mean, the Cyprus bank was not a huge bank, huh? And we had to deal with it in a systemic spirit, because there was a big challenge ahead. So I understand the academic demonstration you're trying to have, but if I look at, if I enter the subject in another angle, which is the reality of the risk I have seen in the past, I'm not so sure. And referring also to one thing you mentioned, is that when I look how the EU was able to face the Credit Suisse crisis, two things. First, you have to remember that, well, one thing I already said, it's two very different business models. Second, what are the link between the two? More or less nothing, except there were two fragile model. That's the real truth. And the truth is that the two models were fragile, because in the EU, why is it the Credit Suisse that went down? Because it was the biggest, weakest, more fragile business model. And same for SVBs. The fly, they go where the meat is rotten. And this is what they do, whatever the business model is. And the second thing I really wanted to say is that what we have learned from Credit Suisse, we just had an event in the AOFR on the resolution. So I'm just going to go to this point right now. But what we have learned, and there was a discussion with Dominique Labourex, and I told him, well, come on, with Credit Suisse, we didn't apply any of the rules we had agreed upon altogether when it comes to bail-in, to the hierarchy of the creditors, and blah, blah, blah. And he answered to me rightly that, okay, but he thought I was completely wrong, because what we were successful is that there was no impact to the stability of the European banks. And he's right. Even though in the nitty-gritty of the details, we didn't go through the road book we had written. But now, so my 2 points I still want to make is one, isn't it that the real look at the business model is the one you need to have through the resolution plan, where you really test and see what is happening in the business model faced with critical situation, which means, because by definition, a business model can be very a changing one. It changes with the impact of new technology, like we are just experiencing with IA, but it's also changing because of consumer practice changes, going to neobanks instead of BNP and Société Générale. This is just the title of the press today in France. So you need to be really looking on not on a daily basis, but it doesn't mean you have a resolution plan. It's going to be for 10 years. And then there's one point I want to mention, because now we are in the middle of this discussion about the CMDI, and which is there to tackle the middle banks, the intermediary banks, with this interesting idea that you could mobilize the deposit guarantee. And this would bring us more closer to an FDIC model, which I've been always arguing for. But the risk is that there's, you know how the negotiation goes in the council from time to time. And I see the risk that through this CMDI discussion, we aggravate a situation where intermediary banks, they go back to national resolution, to a more national trend resolution, and you only have GSIB at the EU level, where the solution for me would be that you would give up this differentiation between the MREL and the TLAC. You have the TLAC for the GSIB, fair enough, but then the MREL should not be a completely different animal. It needs to be a proportionate animal deviating from the TLAC. Nevertheless, in the end, I think it's a good thing that we have a diversified landscape of banks in the EU, fair enough. And when it comes to the international cooperation, well, I think what is at stake in the EU is in the US, it's what we can call techno-Césarisme, MAGA, and Wall Street. And we've seen that Wall Street is not completely silent. So when it comes to the international cooperation that have an impact on financial market, I think there's still some place for not optimism, but cooperation. Hopefully.
Thank you, Bervanche. I think this is quite optimistic, but you mentioned very important elements, and it makes us really think very much on how we can advance the research on those elements. One is what are the determinants?
Rim, do you just allow me, just one point I should have mentioned, is that maybe if you want to enter this discussion, what you could suggest is that when the Commission elaborate a regulation, that they are always eager to have impact study, so that they would have an impact study on the impact of the proposed regulation related to the different business model. Because now they're somehow refusing to do it. And for example, I know in France, we always have the debate about mutuals, because as you know, mutuals are big banks in France, but the model is not so much referred to in the regulation. Sorry to at this point to a very long intervention.
Very nice, Bervanche. This is a very nice proposal. We're trying to do it, but not as a direct impact assessment. We're trying to do it ex ante assessment in a certain way, so just to inform the policy and regulation on the matter. But you mentioned something really essential, which is what are the determinants of a fragile business model? I mean, this is really, if we understand those, we could better understand the resilience factors for a business model, so that we can act again. So this is really essential from a research standpoint. You mentioned Credit Suisse. Of course, Credit Suisse is a Swiss bank supervised by a Swiss authority, eventually having either a branch or a subsidiary in a European, whether it's systemic or not, one has to look at it. So who is going to manage that risk for the consumers from a deposit insurance standpoint. Of course, Swiss is, it's a close country to the European Union, so that's fine. There is cooperation, there is exchange of information, but if it happens that is not, and then the problems are too big, then there is a big problem for the host country. And these are the questions that, in my view, within an uncertainty period like what we're living today in terms of geopolitics, and we are already listening from different EU leaders that we need to work with alike countries, right? Like-minded countries. So this is very, very powerful in the sense that not all countries with whom we've been collaborating at the global scene are like-minded countries. And this is very important also to keep in mind, that we will have a differentiated approach over the years. And then, of course, in financial system, this is essential because you need to really screen and map what you have in your within your national borders. And then whether you are able to contain the accumulation of risks if there would be a systemic risk coming from a foreign country. So these are all new questions that one needs to think very carefully and also understand better, what type of business models other countries are bringing to the European Union and how we deal with it. On the resolution plans, I absolutely agree with you, and this is a great discussion connecting to the CMDI, which I think we're trying also with Doriana, with Barbara and other colleagues to work on, which connecting bank business model and resolution schemes, and also the interaction between the TLAC for systemically important banks and others, MREL, and trying really to create this harmonization between all of those, I would say abbreviations, I call them, but they are all the same logic, and I think we can work on those. But certainly what you're saying is really essential for us to continue feeding our research with from a policy perspective and trying to inform the policy framework. So thank you again, Pervenche, and we will work together now that you have the Association of Europe Finance Regulation, so we can collaborate and then try to do things in the right way, hopefully. Okay, I would like to give the floor straight to Marina Serno. Marina has been working a lot on proportionality. She was a colleague. When I was at the banking stakeholder group, we interacted a lot on the aspects related to bank business models. She's senior policy expert at the European Banking Authority. Marina, I know that you've been busy working on proportionality aspects, bank business models, frameworks. So where are you in this process, and how we can, how our research can help and be useful for the process that you are developing at the European Banking Authority on the single rule book and all these matters? Please, to you, Marina.
Hello, thank you, Rim. Thank you, everyone. So first of all, thank you for organizing this very topical workshop. It is very relevant at the moment to revisit this topic in the context of the new developments on the global arena and in the policy area. And also congratulations with the publication of the study. It's tremendous work over many years, so this is a rightful moment to congratulate you. So I will I actually prepared also a presentation. I don't know if Paula will share it or not. I don't know if she has it. Yeah. Some of the points already have been mentioned by previous speakers, so I will go quickly through them. But I think overall, just to give an overall view of the regulatory perspective on the bank business models, I think it's useful to go through it. So can we go to the next slide, please? Yeah. So as you know, there is different ways of defining business models, and in particular in regulation and supervision, there is no formal categorization. Under the regulation, as the previous speaker mentioned, it's a risk-based approach, same risk, same rule, and proportionality. So we try to apply this approach. This means that by design, each bank is subject to a set of rules that are defined depending on its specific risks. And we should keep in mind that proportionality is also an important aspect of regulation. So in cases when the risks are very small, you can apply certain thresholds and rules do not apply. On the supervision side, business model analysis is conducted as part of the SREB process. Again, as mentioned before, this analysis is a supervisory activity. And what is important is that the business models here are not prescriptive. Each business model is considered as unique. And it is looked at through the perspective of different business lines and understanding how each of this business model is viable and sustainable in the future. Can we move to the next slide, please? So based on the above, the bank business models can vary a lot depending on many elements, including, as for example, in your study, you use the scope of activities and the funding strategies, the ownership and the governance structure. That's another aspect dimension. Other areas that can be considered are levels of specialization, the specific market segment, and so on. The list, of course, is longer than that. You can find here some of the major elements defining business models, which now include also level of digitalization, for example, which we did not have before, but also other aspects. Some of this can be seen on the balance sheet of the banks, but others pertain to their structure, while others to their customer base and target market. So it's a very diverse kind of list of dimensions. Many of these elements, especially those that can be quantified, are also captured in the business model classification of the paper that you presented. And I think this is an important part because it's generally the basis of any business model classification. It is, however, more difficult to do so for qualitative elements, such as digitalization, for example. And this is something that is still a challenge until now to be able to assess the magnitude. In the end, the bank business model represents a combination of all these various elements and how these features work together and ensure the sustainability of the model, and its viability makes each business model unique. Most importantly, each of these features also determines what are the risks and vulnerabilities that the business model is exposed to. So here, for example, you can see on the right column examples of risks that are associated with each of these features. Let's say, for example, if the level of digitalization is high, then the bank will be more reliant on third-party providers. There will be more cybersecurity risk, more ICT risks, and so on. On the other hand, if it's a low digitalized profile, then there is a risk of reduced profitability, erosion of customer base. So the risks can be on either side. The question is really what triggers what vulnerability. For example, low interest rate environment can trigger some vulnerabilities, high interest rate environment can trigger others. So it's really a case-by-case analysis for, depending on the environment, on the adverse situation, where exactly the vulnerabilities can concentrate. Summarizing, the next slide, please. Why are business models important? I think we all agree here, business model features define the risks that are present, and therefore they are very important because this has implications on financial stability during adverse environment. And here are the same examples that were mentioned before, the global financial crisis, the US turmoil. I will not stop here. We have also the 2025, the tariff changes, which again, it's not a direct impact on the banks. However, we see that it has it might affect global growth by raising costs, disrupting productions, and forcing adjustments to supply chains. This may create reduced confidence in consumers and in companies, in investments. And the impact from tariffs generally is expected to primarily affect portfolios such as manufacturing, agriculture, mining, and quarrying, potentially even transport and storage. Again, this is another dimension. This is in the industrial sector of the customer base. Given that UEA has some exposures to these sectors, around 15% of total corporate exposures towards manufacturing, we expect that there might be some impact in the medium term. Thus, banks need to understand how potential tariffs will affect their business model, in particular their corporate customers, their supply chains. And for example, they could look into if the borrowing companies have enough market power to sell their products at higher prices if necessary. So they need to adjust, they need to look into this in more detail. If we move to the next slide. So this As we know, business models are not static. They evolve in response to the internal strategic visions on the one hand and to the external environment developments on the other hand. And the ability to adjust business models and strategies is very important. And it's a key factor to ensure its sustainability and long-term profitability. And some factors that affect business models is macroeconomic developments, regulatory measures, technology. Here I will focus on two aspects that you specifically mentioned, the ESG risks and digitalization. Can we move to the next slide? So I will just briefly go through each of them, and I want to highlight that they are very different in concept, so we shouldn't really lump them together, because also the source of, I think, how it interacts with banking regulation is very different. So on the digitalization side, what is happening is, of course, fintech and digitalization are significant universal trends, changing the competitive environment. The technology is also changing the customer behavior and, of course, raises opportunities. And I think here it's important to remember that most of the changes that are happening are opportunity-driven, because the banks understand that they need to change. This is where the money is. This is where the profit is. EU banks have started to adapt their business models to ensure sustainable profitability, and this includes rethinking interaction with customers, enhancing customer experience through the use of innovative technologies, but also employing new technologies to digitalize, optimize internal processes. There is all kinds of actions here. You can include banks disrupting their own business in an effort to be more agile, partnering with fintech companies, establishing internal accelerators, incubators, investing in conducting equity investments in fintech companies, and so on. Now, all these changes, of course, come with additional risks, reliance on technology, on third-party providers, cybersecurity risks, ICT risks in general. All these new risks are actually very important, and they are mostly encompassed and tackled in the DORA Act, in the Digital Operational Resilience Act. And from this perspective, we also need to remember that currently both all the mandates are reviewed in order to incorporate also changes that came with the DORA Act, to ensure that all these risks are incorporated properly in the regulation and supervision. So now moving to the ESG. On the ESG risk side, the first thing that is important to highlight is that ESG factors are drivers of existing risks, mostly credit risks. They are not seen as separate risks per se. For banks, these are simply factors that need to be used in the assessment of the traditional risks that we already know, such as credit risk, market risk, liquidity risk, and so on. Institutions, of course, should understand their sensitivity to ESG drivers. Can you also move the slide, please, Paula? Sorry, I forgot to mention that. Yes. In particular, environmental transition and physical risks. These risks are not necessarily correlated to previous risks, as they may depend on the type of exposure the institutions have, the geographical location, but also the location of the banks and the ESG policies they are subject to, but they affect banks through the traditional risks. All these details are provided in the EBA ESG risk management guidelines, published in 2024, how exactly to do that. However, unlike digitalization, which is mostly opportunity-driven, as I mentioned, the ESG risks emerge from a given situation, from risks that already existed, the climate risk. It's there. There is nothing that you can do. And these risks were simply acknowledged and need to be incorporated by banks into their business models. However, we also see changes in banks' operations and business models due to business environment, and accordingly, it changes their risk appetite. The business environment change is driven by market drivers, such as new business opportunities. It's not as strong as the risk itself, but there are business opportunities in terms of green bond lending, for example. There is new markets, the consumer sentiment. There is lots of desire of consumers to deal with banks that are green, regulatory change, technological change, and climate-related physical risk. It is not profitable to finance, for example, houses in areas prone to flooding. We can also observe a change in risk appetite. Banks, for example, now integrate more and more ESG factors in their internal governance, policies, and practices, especially in relation to credit risks. Banks implement plans to transition to net zero. Also, banks' sustainable finance, for example, green bond issuances and green lending has been increasing. Most banks, for commercial reasons and not necessarily due to risk profile, offer also reduced rates for sustainable projects. So to sum up, there are new risk drivers related to ESG. However, all of them affect the existing risk categories rather than creating new ones for banks. The question is, of course, how are these ESG factors considered in the credit ratings, in the IRB models, and so on? But that is another question. That is tackled separately. There is dedicated work on this particular topic. So to sum up, maybe on the last slide, we can do a wrap up. So business models are very important. How business models are defined depends on the context and what features of its business model may lead to the materialization of risks, depending on the context. This may have implications on financial stability, as also has been proven in the paper. And from a regulation and supervision perspective, tailored approach we see is that most appropriate.
Naina, thank you very much. This, like always, very nice and inspiring presentation. It gives us a lot of food for thought for the research we're doing. And this is not I'm not doing marketing, but we have a paper on bank business model and digitalization. I think it's already published. Diana, if you can share it with in the chat, that would be great. And then we are working on one on ESG. Also, and business models. So as soon as it is reviewed by the appropriate people, we'll share it with you. But I like very much what you said about that you are moving into an assessment of vulnerability in business models. This is really great because you have much more data than what we have. So you have a lot of data that you can cross and look at. And this allows you from the data platforms that you have at EBA to better understand the sources of fragility and vulnerability. So it's really nice to dig into that further. And if we can learn from you on those elements, that would be really useful for us to go aligned also and to offer our research capabilities to advance further altogether. And also you mentioned clearly that bank business models are not static, so they are dynamic, they move. And you mentioned the factors that we have also informed on those factors in another paper that we published a few years ago on bank business model migration with Barbara and Doriana and others. So we clearly see that we need to continue monitoring because you see the risk moves. You don't know where it goes. It's like it's very, it's smooth in going, and then at a point in time, and as Barbara said, the speed is much quicker now, it explodes and you don't know from where it comes. And this is what we have to be really vigilant to better understand and to be prepared. I mean, early warning systems using the factors of fragilities of bank business models could be really a nice tool to inform, not only the customers, but also, the market players and also a good, nice tool for the regulators. Now, there is one thing which I am asking myself about is, and I don't know, I have no answer. Maybe you can have some elements of the answer. It's the interaction between all these risks, like ESG risk, digital risk, and all of these. They interact at a point in time. And I don't know how we could see some of them on the credit risk, as you mentioned, on the ESG risk part, which impact directly the credit risk, but also could be also the interaction between this operational risk and credit risk revamped with digital and ESG risks, right? And the connections, it's amplified, much more amplified than we might think. Okay, so this is my first question. How can we deal with it within the current frameworks we have? So do we have the right tools and frameworks to deal with this interaction of risks?
So I understand your point indeed, because as we look at the one risk, one same risk, same rule approach, it looks at each risk separately, individually. And indeed, the interaction is important because it's the interaction in the end that might not, you have certain mismatches. And I think that's the main point of the business model analysis that is done by the supervisors, because they're supposed to know each bank individually, closely, and to be able to interact with them to gather information exactly how everything matches together and how it works together.
Yes, thank you very much, Marina. Since I am based in Spain for the moment, and we had a huge problem on Monday, which is the electricity outage. So we've been almost 1 day with no electricity, with no connection, no nothing. So we couldn't access to anything. Of course, this has been man-made error eventually or some other things, but of course, these are important risks that are brought into our day-to-day lives. And these are, of course, extreme events, but with climate change, with cyber security, ICT issues, and eventually the interconnectedness between, for example, the energy infrastructures. This could be a major risk if there is a shutdown of, say, 2 days, 3 days, 4 days, 1 week, 1 month. I've been just imagining on Monday, I said, okay, we have no connection to anything. So what do we do? Have you studied those type of major risks? We don't hear you. Maybe you're muted.
So on the technological side, it's true that on the analysis is mostly on the DORA side, where we look on the reliance on big ICT service providers. For example, many banks relying on the same provider for cloud services. That would be indeed a very big disruption if suddenly we get such a risk materialized. We are at the beginning of the road, as you know. It's not easy. It requires data. That's new data, different than until now. So everyone acknowledges that this is a big risk, and we have all the tools in place, but we need to establish we're in the process of establishing the collaboration with the big companies that provide ICT services. So this is, I would say, that one of the risks that is closest to the risk that you provide. On the disruption of electricity, we do not do that, but of course this is part of the ICT risk, I assume, where they should have generators in case the electricity goes down. So to some extent, yes, we do consider those kind of risks, but I'm not sure if we can prevent.
Okay, so I want to take my argument a bit further. Of course, we need to have, as citizens, some resilience element. I mean, for example, if the system collapses and we have no possibility to use credit cards and our accounts, maybe, this is also a way to go back to the cash. And yeah, on Monday, that's the first thing I had in mind. And I said, how is it possible? I am thinking of cash. So we didn't have cash at home. And you cannot even go to the store to buy anything, even a bottle of water. Imagine you have babies at home and you don't have enough. So we need to really think in a different way. And this also goes back to Christian and Veronique later on. What should we do? We are so much relying on big stuff, technology. And if this technology collapses, we all collapse. And this is something we need to think about from a resilience standpoint. And this is why my idea about resilience, it's not only about, yes, it's nice to have everything under control, but we need to have a lot of tools, a lot of frameworks to have things under control and monitor the risks. But then at the same time, in the day-to-day business, we don't need so many complex things. We just need the minimum to survive. But then if you have a major collapse for 24 hours, more than 24 hours, like 1 week, we have a big issue. We need to think about it all together, researchers, policy, leaders, and everybody else, to find the appropriate way to develop this resilience mechanisms when you are under a big, an extreme event. And my problem is this extreme event happens more frequent, so we need to think about it. So thank you very much, Marina.
If I may, Rim, on this point, since I'm based in Madrid, so I was also a victim to this electricity outage. So indeed, there were many discussions like, wow, we should be relying more on cash. But suddenly, some people put on the table the idea of the digital euro, and that was a nice discussion because some people said, look, the digital euro would not be working in this case, but in my view, the way I understand how it's been designed, it can work offline, it could work in the case of an electricity outage. So maybe a new perspective is being added here to the project of the digital euro. And I mean, of course, that's for technicians to say whether indeed this is fully workable, but maybe this is an avenue that, in case technically possible, would reinforce the case for a digital euro.
Thank you.
It would work only until you have a battery in your smartphone, right?
Exactly. That's another problem. Absolutely, absolutely, Veronique. Thank you for bringing this up. And Judith, you know, you bring me also to a discussion I had with some colleagues in Africa, which they have developed. Actually, there is a technology to have offline digital currency, but it has to be connected to the battery you have, because otherwise you have the same issue if you have no electricity. So yes, absolutely. Okay, thank you all. Thank you, Marina, for this. I would like to now invite Veronique Ormezzano. Veronique, she is an independent expert on financial regulation, financial policy, and she has worked a lot. She's actually the founder of VYGE Consulting, and she has done a lot of work on financial architecture, financial stability, financial regulation. From 2019 to 23, she was the AFME chair, and also she worked in many banks, BNP Paribas, and she was the member of the banking stakeholder group at the European Banking Authority from 2018-24, in the same period, Veronique. So we have shared a lot of those meetings. So Veronique, you have heard about this, you know, the work we've been doing on bank business models for some time now, and, you know, so please, the floor is yours.
Many thanks, Rim, and I'm really delighted to be part of this distinguished panel. It brings us indeed back to the discussions we had at the EBA stakeholder group, where Christian was also playing quite an important role. So it's really nice to have the opportunity. Thank you very much for that. I'm going to speak as a practitioner. I'm not an economist. I'm not an academic. So I really I believe it's really important that all this work is being done, and that there is some conceptual thinking or rethinking of the regulatory framework. And I would like rather to maybe provide more pragmatic practitioner experience and maybe some ideas for implementation. I'd like to start with 3 words that I'm a bit surprised at this stage that I have not heard yet. The first is trust. I think a lot of you have talked about trust implicitly, but not explicitly. So I'd like to start with trust. The second is even more surprising to me. It's risk management. Nobody has talked about risk management. And I will be interested after my speech to understand maybe from you why you may think it's not relevant. And the last one, maybe a little bit more technical, but still quite important, is pro-cyclicality versus counter-cyclicality. So let me focus on those 3 terms and what I'm putting after quite some experience of crisis as well. I was investor relations at BNP Paribas during the GFC. So actually, I faced the crisis from the BNP Paribas angle, which arguably was not the worst, but still quite strongly affected. So starting with trust. My sense is that there will always be banks that lose trust, whatever the reasons. And I would totally agree with Pervenche, who said there was no link between SVB and Credit Suisse, apart from the fact that they lost trust in their customer. You cannot prevent the customer base of a bank, as maybe a car company, when you look at Tesla these days, or any other firm, to lose the trust of its customers. So yes, the speed has increased, but in my view, more fundamentally, the speed doesn't really matter. It matters whether it's a couple of days. I mean, BNP Paribas, you may remember, has bought Fortis at a time where they were losing deposits quite fast, right? Maybe not as fast as SVB, but still, I think the end of the illness was pretty clear, even if the patient took a few weeks, maybe days and weeks, but at the end there was no solution other than being rescued. So the speed matters. It matters actually only maybe because of these weekend expectations of our resolution authorities. There is this thinking. Which I'm sorry to say, I find a little bit strange that we need the weekend time to resolve a bank, and therefore anything that happens before the weekend is bad. So maybe a bit ironically, I would argue on this that what needs to be addressed is the relative value of liquidity in terms of retail deposits or corporate deposits and interbank lending. Because a 7-bank interbank loan lasts 7 days, and it lasts over the weekend. So if the weekend is really the issue that scares the resolution authorities due to the speed of bank run, maybe recalibrating the LCR, not the way that some people think, but by rehabilitating the trust between banks and therefore the interbank market, might be actually quite an efficient way. But that's kind of a little bit of an aside. What is really the most important important thing about trust is obviously two things. First is avoiding losing the trust in the first place, right? And how can we do this? I'll come back to that. And second, when the trust is lost, how efficient are we in the resolution process? And if you look at the US, and I will keep the SVB event a little bit separate, but if you look at the experience of the FDIC in terms of the number of banks they have resolved and the way that the bank is starting again operations on Monday, arguably also after a weekend, but still with all the customer deposits, everything continues as if nothing has happened from the point of view of the customer. This is a very strong way to restore trust extremely fast, and therefore avoid the contagion to other banks that may have similar business models or may be perceived as also being vulnerable. So I think this aspect of the efficiency of our resolution system is absolutely critical. Frankly, maybe I will disagree with Pervenche on this. I'm not sure that CMDI is really going to be the solution. I think the problem is between the numerous stakeholders.
I never said this, Veronique, or otherwise I was missing. I warn on the risk underlying the state of the negotiation. Huh?
Yeah, no, you're right. I think the problem lies in the multiplicity of stakeholders between the ECB and the SRB, with the national authorities, the political debates around it, and so it's a very complex issue. But as long as we do not have an efficient, agile, and really concrete, pragmatic, and decision-making resolution framework, the risk of contagion is actually significantly higher. So that's about when trust is lost. Let me go back to how to avoid losing trust. And this is where risk management obviously comes in, both from the point of view of the bank management and from the point of view of supervision. The first aspect is the sustainability of the profitability, because profitability is the first line of defense to preserve the viability of the bank and therefore the trust of the customer. So observing the diversification and the resilience of the flow of earnings as this first line of defense is something that is included in the SREP, but that maybe in your research you might want to develop more, because I was a bit surprised that you're talking about the diversity of banks, but what is also very important is the diversity within a bank, and in particular talking about a GSIB, a bank that has some systemic importance, obviously. So I think looking at the diversity and the resilience of flow of earnings through time and through crisis times is very important, and would be a very interesting field for research, possibly. By the way, this diversification is not recognized at all in the prudential framework for banks, contrary to insurance, and therefore the view through the regulatory capital lens, if you like, is rather biased, because it's totally additive. Whereas in Solvency II, there is a large part which is taken care of, if I may say so, for diversification. So that may also be an interesting research area of comparing how diversification works for banks versus insurance companies. So that sustainable profitability is a very important aspect of SREP. It should also lead, and I will put this as an aside because it's a bit broader than the discussion today, should also lead to the recognition that profitability and competitiveness, which is intrinsically linked to that, should be part of the mandate. In the same way as the ECB is looking at the profitability from a resilience standpoint, they should encourage the profitability of the banks, and they should really make sure that the whole regulatory and supervisory framework is conducive to improve competitiveness. And I think that's very topical in the current Commission discussion on competitiveness. Let me come to prudent risk management. And there I will address quickly, obviously it could take hours, but quickly 3 points: metrics, decision-making, and supervision. If we start with the metrics, and that's basically the question that Rim was asking, is the Basel III framework still relevant? I think what is really important is risk sensitivity. And risk sensitivity means granularity. It should not be seen as complexity to be removed or reduced. It should be seen as granularity, which is welcome and which is necessary to have a right quantitative approach of risks. So now this brings me to the question of standardized approach versus internal models. Obviously, internal models are much more risk sensitive than standardized approach. I was joking with a friend the other day saying, look, if standardized approach is just an internal model like another one, it's just defined by the regulator, right? It's just a set of rules, right? If you as a bank would come to the ECB and ask for the validation of the standardized approach as your internal model, I bet, and maybe I will lose my money, but I bet that the ECB would refuse it. So that's how bad the standardized approach is. And that's why I'm worried, for example, that the complexity or the unnecessary complexity of FRTB is making the world, not just Europe, but the world, moving away from regulatory internal models for market risk, which I find is really an important systemic risk that we will be facing in the next couple of years, assuming that at some point we will implement FRTB, which is my scenario. Because if you have only 8 or 9 banks in the world that use internal models for market risk, how much uncertainty there will be on the quality and the reliability of risk capital for market for market risk for everybody else. Arguably, the smaller banks may not be so affected, but there's a lot of regional banks active in capital markets, and we want them. I think it's good for the for the market to play to not move into a totally oligopolistic framework, which would not be safe. So clearly, the move or the tendency to favor standardized approach, I believe, is a big mistake. And internal models should be recognized as being more granular and more relevant. By the way, another aside concerning Basel III is that this is why for banks that choose the standardized approach, because it is less relevant, less able to properly measure the risks, this is why the standardized approach has to be conservative, has to be higher, everything being equal, than the internal models. That's why the output floor needs to be below 100, right? But the problem is that having a fixed number like 72.5 works for some business models, but not others. And so by the output floor, we are introducing a huge bias by business model that you may also in your future work try to look at, because actually you can see that depending on the activities, a fixed number for the output floor is working as a backstop or not, and that's also creates imbalances in the competitiveness within Europe and within the various business models. So that's about metrics. I won't go further on this. On the decision-making process, this is where the risk culture intervenes. And there, as much as I believe very strongly personally that it is probably the most important thing to have the right risk culture in a bank and in any other financial institutions, it is probably something which is quite difficult to measure. This is probably something that the supervisors look at and probably should look even more. Thinking about some KPIs, and I don't necessarily like these KPIs, but some evidence, let me say, of a risk culture is something that would be really helpful, I think, because and maybe you can look backward looking at precisely, the various crises and how much losses there were, in specific times in the past and so on and so forth. Of course, the past doesn't, explain the future, but a risk culture is still, as long as you have continuity in management, probably something that is rooted in the culture of the bank. I don't know how to address that, but I believe it is a very important aspect. Maybe looking within your business bank models buckets and try to understand how various banks that are in theory part of the same business model have reacted very differently in terms of profitability and losses during crisis times might provide you with some correlations, or I don't know how, but certainly something that is worth looking at. Finally, on supervision, I think, and it was somebody referred to the Wiseman report. It was clearly one of their main points, which was to avoid the box ticking approach and really focus on the real material vulnerabilities. That's absolutely essential. I'm hearing, all my colleagues that are still in banking, a lot of expressing a lot of frustration that the actual risk that a bank faced at a given point in time in stress time may not be well reflected by the Pillar 1 regulatory metrics. And the SSM continues to be focused very much on the Pillar 1 regulatory metrics. And that basically diverts time and scarce resources in those very intense days and nights away from looking at the real risk. I'm thinking, for example, liquidity risk. Is the LCR the right measure at the time where your focus on liquidity is maybe not 1 month or not the NSFR 1 year, it's 1 day maybe, or intraday. So do you want your treasury team to focus on real-time, data on your liquidity, or do you want your treasury team to focus on answering questions from the ECB about, your LCR has come down from 140% down to 125? How come, right? So I think this focus on reality, actual risks, is very important. Second point on supervision is the capital buffers. This is where all these qualitative aspects that are not well captured under Pillar 1 can take place, and I think it's a very important and still relevant tool. Not everything can be captured by capital in the Pillar 1. I think it would be a mistake, like, the Spanish outage is not something that people can cover with more capital, or be covered with more capital. They probably need generator of electricity, which is going to be money to be spent, as opposed to money set aside as a capital tranche, additional capital slice. So I think the Pillar 2 is very important, but actually the slicing of buffers that we have in Europe is just, unmanageable. And I think we need to be realistic. I'm not going to, how much complexity and overlaps there can be. One thing that is sometimes not understood is that not only there are the requirements by the ECB, but there are also the expectations that the banks have early warnings and recovery thresholds on top of the requirements. So actually, the number that you see as a requirement, and sometimes the surprise that people say, why have banks a 15% capital ratio where their requirement is 10, just to simplify the numbers. This is because they probably have an 11.5 point for recovery, which is kind of expected by the ECB, and then a 13% expected as an early warning before they get to the 11.5% where they need to report and enter into recovery. So we will really need, I think, and I know there has been already some discussions about reviewing the capital buffer framework. I must say that in the US, the stress capital buffer is a much simpler and holistic way that also incorporates the stress test. And I think what is interesting in this one slice buffer is that at the end of the day, I believe you don't care where the loss comes from. You don't care whether the loss comes from credit or market or operational risk or cyber or whatever. A loss is a loss. It's an amount of money. And you need enough capital to cover that amount of money. And not say, this loss corresponds to Pillar 2R or to the counter-cyclical buffer and so on and so forth. So having one pot, which is the right side, and which is covering the overall unknown, if you like, which I would totally agree is very important. So as a conclusion, I would say, is Basel III still the right framework? Yes, as a Pillar 1, but not every risk should be incorporated as additional capital and liquidity requirements. And at the end of the day, the right response to the current polycrisis, as somebody said, is supervision, is efficient supervision, efficient meaning focused on the real vulnerabilities, flexible, judgmental, and empowered, and clearly, the coexistence of several layers of supervision at national level and ECB is certainly not helpful.
Veronique, thank you very much. This is super comprehensive. It raises a lot of questions, I mean, in terms of research that we can do. But then I see the time running, but I want to say one thing, which I absolutely agree with you on the trust issue. Of course, trust is not a word, it's not a philosophy, it has some pillars. So it has to be connected to pillars. And you made me already think that we can connect, and I turn to my colleagues, Barbara and Doriana, that we can connect the concept of trust, define it, what it is for financial systems, and try to connect with business models, because these are things like, for example, regulatory compliance, financial stability, transparency, treating the customers, and then, for example, conduct of an institution too. It's a very important driver of a trust. Also, security nowadays. Security is important, so our banks will have to have the appropriate security measures to deal with the attacks or whatever possible risks in the future. But also fair treatment, the fair treatment of customers. Also trying to really understand the customers and then the different needs of the customers is so important. And also ethics, also contributing to environmental aspects. All of these are elements of the trust. So trust is not really, and of course, I absolutely agree with you. Risk management is one thing, but it's beyond risk management, I think, Veronique, because at the end, a bank is very close. It really manages practically your assets or your money or whatever it is. So we need to be comfortable with the bank. Of course, digitalizing everything might have an efficiency element, but again, and now my head only thinks about resilience, because I know that that's what we need in the future. Yes, efficiency, we've been doing it for years as much as possible, but now we need to think of resilience. And absolutely, I mean, profitability, competitiveness, it's the first line of fight, and I absolutely agree with you. Of course, in terms of the matrix, and one can debate a lot what is a loss, how we can deal with it, but yes, absolutely, there's really a lot of food for thought that we need to think of all together. And I turn to my colleagues Barbara and Doriana, and we have a lot to do in that sense, so we still need to understand a lot of things. So I would like to give the floor directly to Christian. Christian, he's working for Finance Watch. He has ample experience in financial systems, financial regulation. He's currently managing director for also the Center for Economics and Public Administration Limited. So he has been a colleague also for many years at the EBA stakeholder banking group. So Christian, you have heard all of us, and from an academic, industry, policy, regulatory, and supervisory. So how do you see bank business models? And since you're also a member of Finance Watch, how do you see all of this with all this accumulation of risks from particularly a consumer standpoint, from a citizen standpoint, right? Please.
Well, thank you, Rim, for leaving me with the rather monumental task of summing up such a rich discussion. I will not even sort of attempt to do that, but rather sort of try and perhaps sort of bring a few thoughts to the table, which sort of jumped out at me. First of all, also thanks to you, Rim, and Emia for inviting me to joining you today. So I will not sort of dwell on the Basel III framework in particular either. I think Veronique has made a sort of a comprehensive critique, which I think we could and we have discussed in the past, and will no doubt we'll do again in the future. I suppose I would like to zero in on a couple of issues here. First of all, I think perhaps picking up on your recent study, which zeroes in on bank business models, on their contribution and susceptibility to systemic risk. And in a way, their risk-reward profile also, because we always, and risk by reward, I mean their contribution to funding and making the real economy work. So this is one angle that I think should be considered. Secondly, I think you also highlighted very, in a very concise way, how migration of business models, how that sort of is on the one hand part and parcel of the life of a financial institution, but also sort of how it interacts with periods of instability. Third point, the role of the cost of capital in all of this, and especially the TBTF subsidy. Perhaps some thoughts on that. And finally, the role of resolution planning, which I think Pervenche Berès and other speakers before me have touched on. So without further ado, regarding the contribution, susceptibility of business risks, of business models to systemic risk, I find it very interesting from the studies that were presented that they seem to corroborate what I think we have been suspecting for a long time, that market-oriented business models contribute more to systemic risk, ceteris paribus. Not surprising. Ever since Lehman through Silicon Valley banks and banking Credit Suisse, we've seen that actually the classic model of a retail-driven bank run is no longer the main source or the main even symptom of systemic instability. And I think that sort of feeds into the way sort of, I suppose, the systemic risk manifests itself. So it manifests itself primarily through markets and its interactions. And Veronique has, in fact, touched on a very important point there. It is the loss of confidence, but not the loss of confidence necessarily of the retail customer. It's the loss of confidence by investors and professional and or institutional customers in particular that seems to have been instrumental in triggering most of the recent instances of major systemic instability. So this, I think, is an interesting angle to consider. Secondly, the migration of business models. You've highlighted that in times of volatility and crisis, there is a move towards more conservative models, a risk-off mode, basically, and that is a fairly regular occurrence. Fair enough, it's legitimate because business models are not static. But the question, I think, that arises is, when does a legitimate risk mitigation strategy become a channel of contagion in its own right? For instance, when you have, which does happen in those instances, rapid deleveraging and unwinding of positions, etc. In other words, when does the migration from one model to another become a risk factor in its own right? If a business model either sort of proves to be flawed or is implemented poorly, which is another, I think, important distinction, how can regulators and supervisors ensure and monitor that such a migration towards a more conservative model occurs, first of all, occurs at all, especially when the original business model turns out to be flawed or poorly implemented. And secondly, that when it occurs in a timely and measured way, so as to not, as we said, sort of trigger a systemic crisis. This, I think, is an interesting point, which, to me, probably belongs more to the province of supervision rather than regulation. And I think that's a question to be explored further. Sort of when can the supervisor take an active / a proactive role in those processes? The cost of capital and the implicit TBTF subsidy. So looking at your studies, especially sort of the role of the MES. I was wondering to which extent the market observations that you're using, we all tend to use, are still affected by externalities, such as, rather most famously, the implicit TBTF or the GSIP subsidy. I have the impression that this topic has attracted a lot of attention directly in the wake of the financial crisis, but much less so recently, which is, in my view, a bit disturbing because back in 2021, only a few years ago, in the evaluation of the FSB, of the TBTF framework, it seemed to confirm that, as well as quite a few other studies, seemed to confirm that, broadly speaking, the TBTF subsidy is alive and well. Now, if that is the case, and it clearly benefits only some banks, but not others, and it may also be higher for some banks, for instance, some banks with a perceived higher risk business models than for others, then it obviously has an impact on the empirical metrics that we observe, but is not taken into account. Which then again may pose the question whether GSIBs or DSIBs should actually be considered, and in their own right, as a subtype of a business model. More generally, as to the cost of capital, clearly that is a key driver, key argument for a bank to choose between business models. And cost of capital, and I think we've heard some of this argument just now, sort of from Veronique, is also an argument for diversified business models, which, on the one hand, as Veronique was setting out, allows some degree of steadying of profitability, but at the same time could also be driven by the argument of arbitraging cost of capital, using cheap sources of funding like deposits to finance high risk, high return activities. And we're seeing that in these, I think, the type 1, particularly diversified business models that you've defined in your studies. In times of stress, of course, the interdependencies within a diversified group are likely to propagate between the different business model types that are sort of comprised in this diversified group, which triggers arguably internal contagion. In the past, there's been a long discussion around this. I think Pervenche Berès was very much involved, but no doubt many other members of this group around the benefits or not of addressing this issue through structural measures, as it was done in part in the UK through Vickers. This approach obviously has been shelved in the EU, but in the given context, at least from my point of view, this might be something worth revisiting. I would also add to that, again, regarding the cost of capital and the diversified business model, that looking at it, I would say, rather naively from the pure perspective of financial theory, when we look at business models outside the financial sector or outside the banking sector specifically, we seem to be very convinced that in the NFC world, diversification is something best left to the portfolio investor. Surprisingly, in the context of banking, we seem to be of a very different persuasion, which is that it is up to the management to diversify their business models. I think this is a debate which obviously also goes back to the financial crisis and a long time before that, it goes back 100 years. But I think it is becoming again very topical in the context of the many risk factors and crisis factors that we're facing today, and in the context of our questions around the risk profile of business models in particular. And so I come to the final point, recovery and resolution. So this is sort of one aspect that may be reflected in those different gradations of systemic risk across business models that we've seen in those studies and elsewhere in the real world, actually, is that some of those business models are more resolvable than others. Now, this is not really addressed expressly in the study, but it may be implicit in its modeling. Again, a market-oriented business model with large cross-border activities is likely to make recovery and resolution more difficult. That is being partly recognized in the BRD SRM model. For instance, in the group resolution planning, in Article 17, removing impediments, etc., but not really in practice. If different business models have different risk profiles, it would sort of appear logical to take measures, and I think the resolution plan would be the obvious place for that, to ensure that they can be separated in the event of a crisis to stop contagion at the source. And so these options exist in the current frameworks, but they're not being made use of. To conclude, first of all, I could not agree more with your findings that business models do matter, and they matter massively in assessing systemic risk. But that does imply that any regulatory model that defines itself as risk-based should be very carefully calibrated to reflect the risk profiles of different business models. And it is not at all certain that the current regulatory framework does that. If we look at the GSIB-DSIB framework, for instance, it does comprise metrics that can be seen as proxies representing business models, interconnectedness, complexity, etc. But it does not recognize business model and the identification of business model as a sort of risk driver in its own right. That, in my view, is a shortcoming. Similarly, if the viability and the sustainability of the business model is an element of the SREP, but is then not linked in any direct way with the overall assessment of risk, let alone the prudential metrics that flow from it, as we've heard just now, because all of this is done for each bank individually, then again, the value of having these learnings from the risk profiles of business models is lost, unfortunately. Finally, it's difficult to disassociate the inherent risk of the business model and that of its implementation. I think this is another one that, stating the obvious, but still quite important. SVB and Credit Suisse were prime examples of that flawed management can have a systemic impact if, and that's regardless of what the business model does. So there are two levels to it. There is, and that needs to be separated, I think, very cleanly. We have business models, and we have obviously the risk profiles of business models, and then we have obviously sort of the implementation of it or the incompetent implementation of that. The latter is a matter of, in my view, a matter of supervision and enforcement. And that is a facet that is, I'm afraid, sort of still, well, that is at the moment probably a bit out of fashion, because it would likely come with more intrusive supervision, with more regulatory hands-on approaches. But as long as the implementation of regulatory and supervisory norms has no teeth and is largely a function of national and/or political interests, we will not make much progress in addressing this particular risk factor. And then I have one word for RIM regarding resilience, way beyond prudential issues. I agree with the point that was made, I think, by Marina earlier on, that a large part of our resilience planning for the financial sector has been covered or is hopefully be covered by DORA. But I would also note the Critical Entities Resilience Directive, which is complementary to DORA and also covers a quite large part of the universe of financial institutions. But the problem here is one of implementation, because we have now DORA as a vertical framework with clearly the ESAs in charge, and alongside it, the CER, which is a horizontal framework, which is mostly with ENISA and the national authorities in charge. I am perhaps a little less optimistic than Marina that these two frameworks speak to each other in the right way. And I would like to see sort of a more comprehensive management of that. And with that, thank you so much. I will close.
Thank you, Christian. It's a very nice overview. I think it gives us a lot to think about. And I believe that this is one workshop or webinar which will allow us really to interact on different levels. Hopefully, we will keep working together on those topics from different perspectives. And I will get in touch with you separately to see how we could foster our collaboration from these different dimensions that you guys have shared with us. From our side, certainly, we are continuing our work on the bank business models and beyond, on really the new financial architecture, global financial reforms, and the financial stability. We are just to let you know that we have a conference in October in Barcelona on those topics, and I'll share it with you if you can, if you have the time, and also if you have papers and anything that you can share with us. In the meanwhile, I would like really to thank you all for this really, really fascinating discussion on what we can do, how we can innovate to really bring further understanding and on the financial architecture and more stability based on research, evidence-based. I would like to thank Doriana, Barbara, Pervenche, Véronique, Marina, and Judith and Christian for this really nice first discussion that we've had. And we will certainly keep in touch. I see that I am already out of time, 25 minutes. So thank you for staying with us. And hopefully to see you soon in other occasion, but please, let's keep in touch. And thank you again for these really nice contributions. Really nice. Thank you.
Thank you.
Thank you. Bye.